Like a lot of Americans living in Japan, I pay pretty close attention to the current yen dollar exchange rate. And because some of my income and expenses cross between the two currencies, movements in either direction can have a very real effect on my own finances. For Americans visiting Japan, a weekend makes hotels, restaurants, shopping, and just about everything else suddenly feel remarkably cheap. But for those of us actually living here, the picture is more complicated. If you earn yen, travel overseas, buy imported goods, or receive income from abroad, movements in the exchange rate can have a very direct effect on your purchasing power. Normally, currencies move as millions of investors respond to interest rates, economic conditions, and expectations about what comes next. But every so often, a government decides that the market has gone too far and steps in directly. The Japanese government sometimes intervenes in the currency market when it feels the yen has fallen too far. And recently, the United States also stepped in, working with Japan to halt the yen's rapid depreciation. Washington and Tokyo effectively jumped into the currency market together to support the yen, in an extraordinary display of monetary cooperation between the two countries. Initially, it worked. The yen had fallen past 163 to the dollar. Following the intervention, it strengthened dramatically, at one point reaching around 155. That was a very substantial move. But here's the problem. Intervention can change the price of a currency very quickly. What it cannot necessarily do is change the economic forces that were pushing that currency down in the first place. Almost immediately after the intervention ended, the yen began weakening again. Within less than 2 weeks, it had already surrendered roughly half of those gains and was once again hovering around 159 to the dollar, perilously close to that psychologically important 160 level. Which raises the question I really want to look at in this video. What exactly is going on with the yen, and why is it proving so difficult to stop its decline? The first thing to understand is that currencies don't simply rise and fall because traders suddenly decide that they like one country more than another. Money tends to move towards places where it can earn the best return. And right now, there is still a considerable difference between the return investors can obtain in Japan and what they can obtain in the United States. Japanese interest rates have risen considerably from the days when money here was essentially free, but they remain well below American rates. And that creates what is known as the carry trade. The mechanics of the carry trade can become very complicated, but the basic idea is actually quite simple. If money is relatively cheap to borrow in Japan, an investor can borrow yen and then put that money into American bonds, securities, or other assets offering a considerably higher return. As long as the difference in interest rates is large enough, that can be a very attractive proposition. But doing that generally involves selling yen and buying dollars. Multiply that behavior across enormous global financial markets, and you have a persistent force pushing the yen downward. So when the Japanese government intervenes, it is effectively standing in front of that enormous flow of money and pushing in the opposite direction. For a while, it can work. An intervention can be particularly effective when it frightens traders. If you're betting heavily that the yen is going to continue falling and the Japanese government suddenly enters the market and sends the yen soaring 5 or 6 yen in the other direction, you can lose an enormous amount of money very quickly. So intervention changes the psychology of the market. It makes betting against the yen considerably more dangerous. But it doesn't necessarily change the economics of the trade. And that is the crucial distinction. As one expert put it, intervention can temporarily frighten the markets, but money still tends to flow in the direction of the highest returns. And there was something else unusual about this latest joint intervention. The United States wasn't merely standing on the sidelines giving Japan moral support. Treasury Secretary Scott Bessent said the United States was proud to stand with the Japanese government in implementing its policies and helping to stabilize the region. That's an interesting choice of words. He wasn't describing the yen simply as a Japanese domestic problem. He was placing currency stability within the broader context of regional economic stability. And that suggests that Washington was concerned not merely about whether $1 bought 155 yen or 163 yen, but about what might happen if the decline became rapid and disorderly. Despite this, even cooperation between two of the world's largest economies cannot simply erase the forces that are pushing the yen downward. And this is where the Bank of Japan enters the picture. One obvious way to make the yen more attractive would be for the Bank of Japan to raise interest rates further. If Japanese interest rates rise while American rates remain unchanged, the gap between the two begins to narrow. Suddenly, borrowing cheap yen to buy higher-yielding American assets becomes less profitable. And increasingly, the question is no longer whether the Bank of Japan will have to raise rates again, but how quickly it will do so. Market expectations for another increase as early as September have risen sharply since the intervention. But there's a problem. Japan has spent decades building an economy around extraordinary low interest rates. Households have mortgages. Companies have debt. Banks hold enormous quantities of Japanese government bonds. And, perhaps more importantly, the Japanese government itself has accumulated an extraordinary amount of debt. We're already beginning to see the other side of that equation. Japanese government bond yields have recently climbed toward 3%, levels not seen since the mid-1990s, raising increasingly uncomfortable questions about what higher borrowing costs will eventually mean for a government carrying an enormous debt load. So raising interest rates isn't simply a matter of the Bank of Japan turning a dial until the yen goes back to 120. Higher rates have consequences throughout the entire economy. All of this leaves Japan in a very uncomfortable position. Keep interest rates comparatively low, and the yen remains vulnerable. Raise them aggressively, and the cost of money rises throughout an economy that has grown accustomed to cheap financing. But I think there's another part of this story that is particularly interesting, because I can actually remember when the financial environment in Japan was completely different. There was a time when putting a significant amount of money into a 3-year time deposit could actually earn you a pretty substantial return every year. You weren't taking some enormous risk in the stock market. You weren't speculating on currencies. You put your money in the bank, left it there, and the bank paid you a meaningful amount of interest. So saving money didn't merely feel prudent, it made financial sense. And I think that kind of financial experience helped create a deeply ingrained cash is king mentality in Japan. I certainly understand it. If I could put my money safely into a time deposit and receive a decent return without exposing myself to much risk, why wouldn't I? For a long time, that was an entirely rational way of looking at money. Interestingly enough, the Bank of Japan itself has made essentially this point. In the old deflationary environment, holding wealth in yen, particularly in cash and bank deposits, was a perfectly rational strategy. But that world disappeared. Today, bank deposits pay very little. Inflation is back, and the yen has weakened dramatically. So even if your bank balance hasn't changed, what that money can actually buy may be gradually shrinking. And that explains another major shift in Japanese economic policy. For years now, the government has been encouraging people to move some of their money out of cash and deposits and into investments. The government has been promoting what it calls a shift from savings to investment, with NISA being the clearest example. And that makes sense. If cash is earning almost nothing while prices rise, people need somewhere else to put their money. But here's the contradiction. Once you persuade Japanese savers to start looking for better returns, there is no guarantee that that money will stay in Japan. The United States is currently attracting enormous amounts of capital into artificial intelligence, data centers, semiconductors, and other large investment projects. Japan certainly has successful companies and substantial private wealth, but it hasn't yet generated investment opportunities on the same scale. So Japanese investors don't necessarily have to be pessimistic about Japan. They simply have to look overseas and conclude that their money can work harder somewhere else. And that is a much more difficult problem for the Japanese government to solve. You can intervene in the currency market in an afternoon. Creating an economy in which investors enthusiastically want to pour their money takes considerably longer. And this is why I think describing the recent intervention simply as a failure misses the point. It didn't fail completely. It actually stopped the very rapid decline. It pushed the yen dramatically higher. And perhaps, more importantly, it reminded currency traders that betting against the Japanese government isn't entirely without risk. What it didn't do was change the underlying economic incentives. And governments, even very powerful governments, cannot simply order those incentives to disappear. For people actually living in Japan, meanwhile, the consequences are considerably more mundane. A weak yen makes imported goods more expensive. Japan imports enormous quantities of energy, raw materials, and food. When oil is expensive and the yen is weak at the same time, that eventually finds its way into household expenses. So something that begins on a currency trader's computer screen in London, Singapore, or New York eventually turns up in the price of gasoline, electricity, food, and countless other things that people in Japan buy every day. Of course, there are also winners. Japanese exporters can benefit from a weaker currency because profits earned overseas become more valuable when you convert them back into yen. Foreign tourists find Japan extraordinarily inexpensive. And somebody earning dollars while living in Japan is in a very different position from somebody living on a Japanese salary or pension. But for ordinary households whose income and savings are denominated in yen, prolonged currency weakness can amount to a gradual erosion of purchasing power. And that is why 160 yen to the dollar has become more than simply another number on a financial chart. It has become politically significant. Now, that doesn't necessarily mean the government will automatically intervene the moment the exchange rate touches 160. Japanese authorities generally pay attention not merely to the level of the yen, but how rapidly and disorderly the movement becomes. But after what happened recently, traders now know that Tokyo is willing to intervene again. and they also know that Washington may be standing beside it. So we have arrived at a rather strange standoff. The market continues to have powerful economic reasons to sell yen and move money into higher yielding or more attractive assets overseas. The Japanese government is determined not to allow that process to turn into an uncontrolled collapse. And the Bank of Japan is under growing pressure to normalize interest rates without creating new problems elsewhere in the economy. Meanwhile, ordinary Japanese households are being encouraged to abandon a savings strategy that worked perfectly well for generations and venture further into investment at precisely the time when many of the most attractive investment opportunities may lie outside Japan. Intervention can buy time. It can slow speculation. It can punish people who become too confident that the yen will simply continue to fall forever. But unless the underlying incentives change, it probably cannot determine the long-term direction of the currency, and that may be the real lesson of Japan's yen-dollar blues. The Japanese government can fight the market. The United States can even join the fight. But sooner or later, somebody has to change the economics. This has been Gaijin 50 Plus, and I'll see you in the next one.